Welcome to Serious Business on NDTV. 30 minutes of hard business news. One topic, one speaker, and a conversation that's relevant to you. I'm Manvi Sinha Dhillon. Samvat 2079 has ended, and with Diwali, the new year, Samvat 2080 has begun. Yes, I'm using the Indian calendar references here, which stock market investors are very familiar with. So it's the new year and a good time to take stock and look ahead. What is Samvat 2080 likely to bring? What should be the top investing strategies and principles for the new year? Well, it's my pleasure to welcome Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company, a market veteran of 25 plus years. He's seen a dramatic evolution of the Indian stock market in his career of 2.5 decades, and we're very glad to be able to leverage his experience on Serious Business today. Nilesh, welcome to NDTV. Happy Diwali and a Happy New Year. So glad you could join us.
Thank you, Manvi, for having me over here, and wish all the viewers of NDTV a very, very happy and prosperous new year.
Nilesh, we can't talk about the future without context. So reflect on Samvat 2079 and what, according to you, were some of the things that really stood out in the past year?
I think the biggest difference last Samvat was about investor confidence. The retail investors normally used to panic when foreigners used to sell. But now things have changed. There is a class of investors who is doing regular investment and providing counterbalance to foreign portfolio investors. Today, when I meet investors, they are super confident about India growth story, which wasn't the case, let's say, a few years back.
Well, interesting. I'm going to talk about that a little later in our conversation. Super confident investors. Is that always a good thing, or could there be some room for tempering that approach? But I'm going straight to the fundamental question, Nilesh. How should retail investors approach the new year?
Well, one, they should not invest somewhat to somewhat. Equity is a far longer play. Second, don't bet against India. I have never seen India growth story as good as it is getting today. We have now talent staying back in India. This wasn't the case earlier, where talents from India's premier management and education institutions used to move abroad for better opportunities. Second, talent also requires capital. Earlier, your parent was sources for your capital. Today, there is a vibrant private equity and venture capital industry, which is providing abundant capital. More importantly, talent and capital also needs infrastructure. Otherwise, the bottlenecks will shut down the business. India is building between 2014 and 24 almost as much infrastructure as it was built before 2013. Roads, ports, power, airport, telecom, metro. Everywhere there is massive infrastructure investment happening. Put together talent plus capital plus infrastructure, India growth story looks very, very promising. Undoubtedly, there will be ups and downs, but the journey of the fifth largest economy of the world becoming third largest over the next couple of years and beyond that will continue.
So let me just quickly inject a phrase that I heard you use recently here, because this is a good point at which to understand it. 3G. What are you referring to when you coined that 3G phrase, Nilesh?
Essentially, what are investors looking at in India? They are essentially looking at three things. Growth. Our earnings growth should be superior to our peers. Last quarter, that is September 23, our earnings growth came at almost 24%. Many emerging market peers haven't given that earnings growth over a period of number of years. As long as our earnings growth remain better than our peers, we'll continue to get premium valuation, will continue to get investors' attention as well as money. The second thing is governance. There are many countries where governance standards are fairly poor compared to India. Thanks to SEBI and Finance Ministry, We have brought corporate governance standards almost at par with the Western world. It is a journey. We have to keep on improving, but our governance standard gives confidence to investors. And the final thing which we haven't talked much about, but we should emphasize, is green transformation. We are the lowest per capita carbon emitter in the world. We are one of the few emerging market countries which is on its way to achieve COP26 commitments. Combination of this 3G, growth, governance, and green, will ensure that investors continue to focus on India and continue to put money into India.
I'm not an inherent skeptic, but we do have to take stock, Nilesh, of some potential risk to the market in the medium term, in the short term. And I'm going to run through a list of commonly held sort of concerns. They start with oil, trajectory of US interest rates, geopolitics and their impact on sentiment beyond oil, back home, consumer sentiment, particularly at the bottom of the pyramid, and finally upcoming state elections and then general elections mid-next year. Have I presented a comprehensive list, A, of the risks, and B, do you really see these risks impacting or not impacting or medium sort of level impact on the stock markets?
So undoubtedly, these are all the risks which market is aware of. But fortunately, some of the risks are mitigating itself. For example, oil was threatening to go to triple digit. Now, this was primarily led by cartelization by OPEC and non-OPEC countries. Fortunately, US proposed relaxation of sanctions on Venezuela. Venezuela has more oil reserve than Saudi, but their production at 750,000 barrel is nothing compared to 12 million a barrel by Saudi. Now, as long as Venezuelan oil supply can keep check on the oil cartel, oil prices will remain in a reasonable range. The real risk for India is complacency. So many people have told us that, look, this is India's decade, this is India's century. But we have to keep on investing. We can't become complacent. Maharashtra, the state where I belong, today it has same GDP as whole of India had in just 2005. So in 17 years, Maharashtra has reached where yesterday India was. Over the next 17 years, I believe Maharashtra has potential to reach where today India is. But that's not going to happen unless until we continue to innovate, we continue to improve, we continue to work hard. We should not take growth for granted. We should not become complacent.
Okay, we've touched upon all the risks, Nilesh. I want to get to the nuts and bolts of investing in the months and years ahead. Your point, well received. Don't look at investing from Samvat to Samvat. And I'm going to underline that for everyone who's watching this conversation today. But nuts and bolts of the strategy. And I'm going to just give you a flavor of the kind of insights one is looking for. You've said again in recent conversations you've had over the last couple of days, invest not looking at the past, invest looking at valuations. So I get the sense that valuations sort of is being underlined in your advice to retail investors.
Undoubtedly, yes. Today we are living in a strange market where many of the smaller caps and micro caps and mini cap stocks are trading at a higher valuation than large cap. This does give them great performance track record. But at this valuation, does it make sense to invest in them? And if yes, what kind of return you can expect? Some of these stocks, especially at the lower end of the market capitalization, had very, very limited floating stock, 4, 5, 10%. This is in the hands of few investors, and which is why valuation and consequently prices are higher. I think at this price, this valuation, if you invest, your time horizon to invest has to be really longer and your return expectation has to be much, much lesser. I think it is far better to invest into large caps and larger mid caps where valuations are still reasonable. For example, a banking and financial services sector. It has underperformed the market for last 18 months, but now valuations have become cheaper. The results expectations are reasonably decent. Profit growth is reasonably okay. So going forward, it makes sense to invest into sectors where valuations are reasonable rather than where past performance is looking very, very good due to high valuations.
So I'm going to paraphrase and sort of apply one of the other phrases you use in the context of your comments right now. Growth at reasonable prices. That's been one of your mantras for investing. You've pointed our viewers towards banking, for example. Which other pockets of the market would you direct our viewer attention to? Banking, point taken. But beyond that?
Beyond banking, we believe manufacturing is a bigger theme. A lot of companies are trying to diversify China, and there are many countries which are trying to grab China plus one trade. But all those markets put together does not have large domestic market like India. We believe those Indian companies which cater to domestic market and which are competitive to become part of global supply chain management will truly have double engine of growth. Local market plus global market. This can create a multi-year growth for them in business as well as margin. So any company which is riding this China plus one trend and which is competitive, I think that theme is a multi-year theme. It will reward investors handsomely. We saw that kind of trailer or film in tech sector, in generic pharma, in chemical sector. Undoubtedly in those sectors there were ups and downs, but the underlying theme of competitive solutions was always there. There will be many such sectors in manufacturing whose performance will be like the techs, generic pharmas and chemicals of yesteryear.
Again, I'm sort of zooming out and asking for a bird's eye view. From earnings season so far, Nilesh, what's the picture that's emerging? And I know it's not a complete picture yet, but it would be good to sort of give that overall perspective on Indian corporate health as it's emerging from earnings season so far.
So the numbers are too good to be true. This is probably first quarter after many, many years where every single sector collectively has outperformed expectations of investors or meet the expectations of investors. Very rarely we have seen this kind of broad-based performance. And this performance is not necessarily volume. It is more driven by margin. That means companies are cutting cost and becoming competitive. If we look at large, mid and small, across entire breadth of the market, results are literally ahead of expectations or meeting in line with expectations. Corporate leverage is at one of the lowest level. Corporate profitability is almost 4.5% of GDP. That means they are generating cash and they are deleveraged, and capacity utilization is now above long-term average of 75%. My feeling is that we are looking at one of the best corporate scorecard in terms of performance this quarter.
Well, that's certainly positive news, and I'm going to ask you to don two hats now. Managing Director, Kotak Mahindra AMC, and also member of the Prime Minister's Economic Advisory Council. So if you had to kind of sum up the India story, the India opportunity, and that of course feeds into how the stock markets will perform, how would you sum it up, risks included, at the macro India story level?
So undoubtedly there are risks which we will have to manage. For example, the world is seeing in a disruption in enormous pace, and we are not leader in disruption. Artificial intelligence is hitting us. It's a way of life. India does not have a foundation like, let's say, US or China. We are making applications using AI, but we don't have our own AI. At some point of time, like India today is pushing towards having its own fabrication plant, we should be focusing on creating our own foundation so that we cover the complete value chain of artificial intelligence. But let me give you one small incidence about how India is changing. There's a particular step well in Hyderabad, Telangana. It's called Bansilal Pet. It was dirty, uncared for, even though it was historical monument. Our economy prior to 1990 was like that. We were growing, but others were growing at a much faster pace. Today, when you visit Hyderabad and when you go to Bansilal Pet, it has been transformed with the effort of government and NGOs and public. It has become a tourist spot. Its historical value is signified. My feeling is that India's economy is also in that transition. Prior to 1990, we were old Bansilal Pet. By 2047, in our Amrit Kal, will become as good as today's Bansilal Pet. That picture is the transformation of India. Talent, capital, infrastructure put together, we will become one of the from being coach of the global growth train to the engine of the global growth train.
Simple analogies that our viewers will be able to absorb and understand. On that note, Nilesh, we're going to take a quick break on serious business. When we come back, I'm going to put a couple of provocative questions to you. One specifically on why you don't think that more people haven't become mutual fund investors. But we're going to pick up that conversation with Nilesh Shah when we return. Welcome back to Serious Business on NDTV. We're in conversation today with Nilesh Shah, Managing Director of Kotak Mahindra AMC, a veteran, respected investor in the Indian stock market. Nilesh, let's pick up our conversation, and I warned you I'm going to talk about retail investors in India. Well, first up, you've seen this market for 2.5 decades plus, right? So you've seen the evolution of the institutions, the framework, the structures, but you've also seen the change in the mindset, homework, attitude of the retail investor. How would you describe the retail investor today?
In one line, earlier, say 5-7 years back, when market used to correct, we used to go to our distributors and investors and give them confidence that don't worry about the correction, long-term story looks good. Right now, FPIs are selling and that's why markets are correcting, but our fundamentals are fine. Now, when markets correct because of FPI selling, those guys call us up saying that you don't worry, Nilesh bhai, we are sending you money through our SIPs, our lump sum investments. Just ensure that you keep on buying quality stocks. I think there is a set of at least 4 crore investors in Indian mutual fund who have really very, very high confidence about India growth story, who wants to be a regular as well as long-term investor. I just hope and pray this tribe continues to grow.
Which brings me to what I said would be a provocative question. Are you surprised, Nilesh, there aren't greater numbers of mutual fund investors, given the numbers that we seem to see when it comes to investing in crypto, for example?
Undoubtedly, it is actually painful. Wherever there is an opportunity to lose money, I see people lining up. 18 crore Indians have dabbled in crypto, most of them. More than 2 crore investors, especially at the bottom of pyramid in rural India, have dabbled in Ponzi schemes. Most of them would have lost money. There are so many people who trade in futures and options. Majority of them end up losing money. So it is very, very painful to see where there is a sure shot way of making money, securing your financial future. We are not seeing as much participation as before. But then I go back to what I learned in my career at Franklin Templeton, when their founder Charles Johnson had come. He had mentioned that mutual funds are always J-curve. You keep on working hard for decades and people keep on observing you, testing you with small sums of money. And eventually your time comes where you take off. So be very, very patient with mutual fund industry. It's a J curve. And my feeling is that we have reached the inflection point now. What was our investor base prior to COVID? We are almost increasing it by 50% in post-COVID era. As we get more and more happy customers, hopefully we'll be able to spread this tribe from 4 crores to 40 crores.
Okay. I'm coming back to those who are already invested in the market. Whereas, we hope the tribe will grow, but those who are already invested. For the medium term, what is that one mistake, Nilesh, that today, sitting here in November 2023, you would caution retail investors against making that mistake in the months ahead? You talked about the bullishness of retail investors. Again, pardon the skeptic in me, I'm wondering if some of them could be over bullish, for example, when it comes to the small and mid-cap universe. But that's just me talking. We want to hear from you.
So there's always one mistake made by investors, which ensures that the fund return and investor return differs. Globally, we have seen that people who are dead, that means who haven't touched their mutual fund, they have actually benefited maximum out of mutual funds. Now, obviously, we don't wish our investors dead. But many a times what happens, people invest looking at past performance. They end up chasing past rather than future potential performance. And as you correctly mentioned, Manvi, the small and mid-cap performance look good. A lot of flows are coming over there. My recommendation to investors will be a regular investor, because little drops of water will make an ocean. Be a long-term investor, because, jaldi ka kam shaitan ka. I really don't know the English proverb for that. And finally, don't invest looking at the rear view mirror. Look at investing in the future potential. If you maintain a disciplined asset allocation between debt, equity, gold, and real estate, I think you are set for financial security.
And those are wise words at which to end our conversation. Nilesh Shah, it's always a pleasure talking to you. Thank you so much for making the time to join us on Serious Business on NDTV.
Thank you so much.